Hello everyone, welcome back to Financial Modeling and Business Simulation class, session 5. Our discussion topics today are first, operating budget. We are going to create operating budget for your business, and then PPE schedule, or this is a fixed asset schedule, consists of depreciation, expense, and accumulated depreciation. Actually, this is like the annex of your operating budget. And financing schedule, basically we are going to calculate interest expense and your debt schedule. And finally, I will show you how to create landing page for your financial model. So let's start with operating budget first. This is the layout of operating budget. There are several sections. The first one is assumption. Actually, this assumption is the growth assumption or the escalation assumption. And then we have revenue budget. We have cost of goods sold budget and operating expense budget. And basically, we need your input assumption to create the operating budget. So your input assumption that you have created a week before, it is very important as we are going to start to develop the operating budget. So here we have the period of forecasting. This is my period of forecasting. I start from year 2021 and the end is 2031. So my period of forecasting is of 10 years. So in group, for your group assignment, you just need to create a 5-year operating budget. However, if you do the exercise individually, you can create a 5 years forecast or a 10-year forecast. It is really up to you guys. Okay, let's start with assumption. First, this assumption, I include sales volume growth per year and sales price increase per year, cost increase percentage per year, and income tax per year. So if any of you wants to include any other assumption here, any other growth in here, such as you will separate the cost of goods sold growth and operating expense growth percentage, it is also you are allowed to do so. So this is only example. You can develop this according to your business assumption and business needs. So let's take the sales volume growth here. For example, I consider the sales volume growth percentage for every year is 3%, and it is a constant of 3% in every year. The growth is 3% in every year. However, if you do not want to use the fixed rate, maybe you will uh, you will you want to use a different rate for each year. For example, this is 3% and 4%, 5%, etc. You are allowed to do so. So this is again only an example. You can use your own assumption for the growth of sales price, cost increase, and income tax rate. All right. So actually, the income tax rate is fixed 25% per year. There is no change for income tax rate. I will assume this is fixed one. Let's just assume that the government will not increase the income tax rate for the upcoming 10 years. Meanwhile, your cost is steadily increased to 2.5% each year, and your sales price will be increased 5% each year. Okay, so this is the growth assumption. And then why the color is blue? We use blue font because this is manually input. We do not use any formula here. This is from your input assumption. Unless you insert your input assumption tab here and put like a formula there, it will be black. But if you input this manually, you should write it in blue color, right? And let's move to another part, which is a revenue budget. Revenue budget mainly consists of product sales volume and price per unit and revenue budget here. Revenue is the multiplication of sales volume with price per unit. Actually, we got the product volume in first year based on your input assumption. So that's why the color is blue here for product and for price per unit, you get this from your input assumption. So just put whatever you write in your input assumption in the first column here. All right, so let's move to another column here. For the second year here, we have a 3% growth each year. So we want to multiply the volume in the first year with the growth. However, as volumes should be stated in integer, or in Indonesia, we could say that it is bilangan bulat. So you want to round this up. So basically, the formula to calculate the volume growth in the following years will be like this. You multiply the first year volume here with the sales volume growth here. Sorry, 1 plus volume growth. It should be like this one. This is the basic formula. However, there is a risk that your volume is not an integer. However, the volume, if your product is not like something like water or sugar, that your product is like stated in units, it should be stated in integer. So that's why I will add a new another argument here. I will add round up. So it is really up to you. You want to use round up or round down. However, I will use round up. So if you have any decimal behind the comma, it will be upgraded. But if you have round down, if you have some decimals behind the comma, it will be downgraded. The number will be downgraded if you use round down. However, I will use round up, and the number digits will be 000 number behind the comma, something like this. And I will just drag to the right for the rest of the year. The rest of the forecasted year, you just need to drag it to the right, and you will have the volume for year 2022 up to year 2031. So that's how you calculate the product volume. So this is for product one, and if you have more than one product, you do the same things with the product one here for the rest of your products. And that's for the volume of sales, the sales volume. And let's move on to another issue, which is a price per unit of your product. The price per unit, you also get this one from your input assumption. So that's why the color is blue, because no formula here. And actually, this is the similar formula with how you calculate the volume before. However, it is up to you whether you want to use round up or not. However, I will use round up, and I will state that I want two digits behind the comma. So this is very up to you. You want to use round up or not? This is up to you guys. Okay. The formula is basically similar with the first one, and for revenue, you just simply multiplying the product volume with the price per unit, and you will have the revenue for each product. And do not forget, if you have more than one product, you need to duplicate again. You need to redo again. You need to redo again the step for product number 2 and product number 3. So after you have the revenue, and you can just calculate the total revenue for your whole year by just summing up the revenue from first, second, and the third product and drag down to the right. Just something like that. We can simply use sum here. Okay. So that's for the revenue budget. And then the next part, we have cost of goods sold budget. Cost of goods sold budget. Actually, we already computed the cost of goods sold budget in input assumption. So you can just simply input your COGS here, your COGS here, or you may want to add another sheet to calculate your cost of goods sold. I will not explain this further, because I think you already create this cost of goods sold when you create the input assumption. So just follow the same step as calculating the cost of goods sold as you have done before in your input assumption assignment. All right. So if you already have your cost of goods sold here, this is why I use transpose here, because this is actually the cost of goods sold here is stated in row. However, I want to move the cost of goods sold in here to column format, so I just use transpose here. All right. And after that, for the cost of goods sold in the following forecasted year, you just simply follow the similar step as we have conducted before in computing the price and volume. You just simply multiply the cost of goods sold here, cost of goods sold in year one here, with the one plus with the growth of your cost increase. If again, if you wish to separate the cost of goods sold growth and operating cost growth, it is you are welcome to do so. However, in my assumption, I will make the cost increase of operating expense and the cost of goods sold similar, 2.5%. I will not differentiate between cost of goods sold and operating expense. It will be 2.5%. So as long as you have a strong justification, so you are more than welcome to do so. So let's just make it a two number before, sorry, after the comma, and you will get your cost of goods sold per unit here. And repeat the similar step for your next products or services. And to compute the total cost of goods sold, you just simply multiply the cost of goods sold per unit with the unit sold here. Okay, and the total cost of goods sold is the sum is the uh, you can just simply add the cost of goods sold from product number one, product number two, and product number three. This is very simple, and you could just use sum here. After that, you can calculate gross profit by deducting the cost of goods sold with revenue. Revenue minus cost of goods sold is equal with a gross profit. You will have your gross profit and also for forecasted gross profit for the next 10 years of your, or the next 5 years, 10 years of your forecast period. Again, if the font color is black, make sure that you use formula here. You use appropriate formula here. This is for gross profit. After we have the cost of goods sold budget, final one is operating expense budget. This is also operating expense. Please classify your operating expense here that with what you already made in your input assumption. For example, salary expense, maintenance expense, utilities expense, etc. Advertisement, etc. You just put it here for the operating expense in year one. Meanwhile, in the second year and the rest, you simply multiply it with the growth. Multiply the operating expense here with the growth of the cost. So I just in my case I use the similar cost increase here with the COGS. So this the similar way for operating expense, another operating expense. So repeat the similar step for the next operating expenses. While for depreciation and amortization, we will discuss it later on. And you have the total operating expense here, and earning before interest and taxes is simply by deducting the operating expense with the gross profit. You just simply uh, do the calculation like gross profit minus the total operating expense, and you will get EBIT, or earning before interest and taxes. And you will have your interest expense here. I will also discuss the interest expense in another session, in another slide, in another section after this. In financing schedule, we will discuss how to calculate the interest expense. If you have earning before interest and taxes minus interest expense, you will have your earning before tax, and the income tax expense simply just multiplying the EBT, earning before taxes, with the tax rate here. And our tax rate is constant for every year, which is 25%. That's the EBT. Okay, the EBT. Okay, the income tax expense, and the net income is earning before taxes less income tax expense. You will have net income. So this is for operating budget. We will explain in more detail of how to calculate depreciation, amortization, and interest expense in the next discussion. So let's move to another topics, which is PPE and intangible asset schedule. We will use the output from the schedule as an input for our operating budget and our financial statement, which we will create later on. So there are several sections here. The first one is opening balance section, PPE acquisition, intangible asset acquisition, and closing balance. The opening balance stated or defined the beginning balance at the beginning of the period for each forecasted year. And for instance, here in year one or in year 2021 here, um, the beginning balance of your PPE and intangible assets is zero. And do not forget, since we input this manually, the font color should be blue. And meanwhile, for the next forecasted year, we will get the balance of this opening balance from the closing balance of the previous year. That's why we are going to get back again to this after we compute the closing balance. And after that, we have the PPE acquisition section. PPE acquisition section defines your PPE acquisition, in which year you purchase the PPE, how much does it cost, how much is their residual value, how much is their useful life, and also the depreciation expense in each of the forecasted year. For instance, here I have four PPE which are purchased in four different years in 2021, 2023, 2026, and 2029. However, if in year one of your forecasted period you want to purchase more than more than one PPE, you can just simply add more add or insert more row in here. Just insert more row and define what is the PPE name. In here, I do not use any specific PPE name. I just put PPE number 1, 2, 3, and 4. However, for your financial modeling or for your group financial modeling, you should specify what PPE that you need in here. Okay, so for PPE number one, I purchased it in year 2021. The cost is 30 million, no residual value, and the useful life is 10 years. So let's calculate the depreciation expense first. Actually, the formula looks a bit complicated here. Anyway, it is not that complicated. We start from the we start from the very last part of the formula, which is SLN1. SLN stands for straight line depreciation, which means we use straight line method as to depreciate the asset. Anyway, you can use another depreciation method such as a double declining balance. For convenience to calculate the depreciation, let's just use the straight line. And moreover, straight line is, I think it is most common depreciation that we are using in reality. So this straight line here, the D12 here is actually the cost acquired, the D12 here, cost acquired, cost of acquisition, and E12 is residual value. We have no residual value here, and F12 is the useful life. This is the first formula, and if you see here, I use string in here, string in front of the D, E, and F, or in front of the we call this as column, or in front of the column, or in front of the alphabet. It means that I want to lock the column in here. I want to lock the column, but I want to make it flexible to drag it vertically. You can drag it vertically, but it is not flexible to drag it horizontally. If you drag this horizontally, sorry, it will not change to E, because if it changed to E, the E in column E, it states the residual. Anyway, I do not want to change the cost of acquisition here. That's why I put a string in front of the column here. However, if you drag it vertically or downwardly, it will change. Let's pay attention to this one. In here, the formula is D12. However, you can drag it vertically, and it will change to D13. However, the D here is not changing. Okay, so that's why I put the string in front of the alphabet. Alright, so the second argument is if error. If error is to return the value to zero whenever there is a mistake. So there will be no such thing like num, hashtag num, or hashtag error, etc. If there is an error, the value will return to zero. I put the zero here at the very last of the argument. Okay, that's it is with the depreciation expense. Actually, if you just put the SLN here, if you just use the SLN here, you will get the depreciation value. However, it is not flexible enough, because if you want to calculate PPE number 2, you have to start from 2003 manually if you just use the SLN. And however, I want to make a highly flexible formula. That's why I add another argument here. Another argument here is, you can see here, if H3 here is current year or forecasted year in here. Yes, the current year minus the acquisition year plus 1 is more than their useful life. The depreciation expense value will be 0. It means that if the forecasted year exceeding the useful life, you do not need to depreciate the asset any longer. While we also have the second if here, it is actually similar. However, this is less than 0, which means if the current or the forecasted year minus the acquisition year plus 1 is less than 0, the depreciation value is also 0. That's the third and fourth argument of our depreciation expense formula. So let's have a look at PPE number 2, for example, because PPE number 2 is purchased in year 2023. And its useful life is only 4 years. Because this formula is highly flexible, you could just drag it down, or you could just drag it horizontally. This is the formula is already very flexible, as long as you pay careful attention with the string here, where I put the string here. Okay, for let's say PPE number 2, which is purchased in a year 2023, because in year 2021 the depreciation value of PPE number 2 is still 0. Why? Because according to the argument here, if the current year, which is 2021 here, deducted by the acquisition year plus 1 is less than 0, the depreciation value is also 0. Okay, so there will be no depreciation expense for PPE number 2 in year 2021 and 2022. However, in year 2023, because the acquisition is in this year, if we deduct 2023 with 2023 plus 1, this is more than 0 or 1, so we have a depreciation expense here. And the condition is SLM, D13, E13, F13, etc., etc. It will be depreciated according to the straight line depreciation method. And because the useful life is only 4 years, after year 2026, the PPE number 2 is no longer depreciated, or its depreciation expense will be 0. So that's the formula here. Okay, you can see here, if we put the string before the numerical value, or before the row, the number states the row. This is useful to lock the row. So it will be flexible to drag it horizontally, but the column doesn't change if you drag it downwardly or vertically. So we already have the depreciation expense for each year, and to add the depreciation expense for each year, you can just use sum here. Okay, this is for depreciation expense, and we will use this depreciation expense value in operating budget. So just you can use the depreciation expense value from here. Okay, and the next one is intangible asset acquisition. This is very similar with PP acquisition, but we have amortization expense here rather than depreciation expense. The formula is very similar with the first one. You can just copy and paste the formula, but make sure you use the correct reference in here. Make the correct reference. And then if you have more than one intangible assets, you are allowed to put the name here. What is your intangible asset in here? If you are acquiring more than one intangible asset in the similar year, just insert another row. Just insert another row here. Okay, and define what is your intangible asset, when you acquired that, and how much is the cost, residual, and useful life, and etc. So that is for the amortization expense, which we can get from the intangible asset acquisition section. And finally, the closing balance. We also use another complex formula here. The closing balance basically is the opening balance in here. Opening balance. Basically, closing balance of an asset is opening balance minus the depreciation expense. That will be the closing balance of your asset. And we are going to make another flexible formula again. So H6 here is the opening balance plus sum if. I use sum if here, sum if. And if you use sum if, the argument for sum if is the range. The range in here is the year, and here, and the criteria is the current year or the forecasted year, and the sum range is the cost here. Okay, so actually basically the sum if function here stated that whether in the current year or whether in that specific forecasted year, whether there is any additional asset acquisition. So we use sum if here. So if there is no asset acquisition, we do not add the opening balance with the asset acquisition. However, if there is any asset acquisition in that specific forecasted year, we will add the opening balance first with the any asset acquisition during the forecasted or the current year less depreciation expense. So this is also already a flexible formula because I already put string in here, put string, and H16 basically this is the depreciation expense in the specific forecasted year. So after you read this formula, you could just simply drag it to the right or drag it horizontally for the rest of the forecasted year. And the similar formula also goes to intangible asset. And the closing balance of your PPE and intangible asset, just simply add the PPE and intangible asset here, and the closing balance in the first year will be the opening balance in the next year, like this. Sorry, formulas. So use 27 in here from 27 the ending balance of PPE in year 2021. So that's all for PPE schedule. And this is the final schedule that we are going to make, the financing schedule. The financing schedule consists of debt financing schedule and equity financing schedule. As for debt financing schedule, it indicates when you acquire the debt and how much is your interest payment and principal payment. Okay, let's go to debt financing schedule first. For debt issuance, it indicates in what year you issue your you get your debt or loan maybe from the bank, and how long is the due period and how much is the interest rate. And the first one, this is the debt payment schedule. It indicates the annuity of principal payment. So this is just the principal payment. While in the interest expense calculation here, it calculates the interest expense using effective interest method. So let's go to the first one, the debt issuance first. We have three times of debt issuance here in 2021, 2025, and 2029 here. So the formula for calculating the debt payment schedule, the basic formula here, we see here, we using a PMT here or payment, the PMT here, PMT. And while the rest of the formula is similar when you calculate the depreciation expense. So let's go to the PMT first. The PMT basic value is here, rate in here, rate. The rate here is the interest rate, which is 7.5% here, or in column E9, in cells E9. And here we give string in front of E so that it will be flexible to be dragged down vertically. However, it will be locked if we want to drag it horizontally, because we want the interest rate here for year 2021 to be stick in 7.5%. So we provide string in front of the alphabet here. And the D9 here is the due period, or they said this is n pair or the number of period here, which is the due period for the first loan. It is in cell D9, and similar with E9, we also want to use the 10 years due period for year 2021. So we lock the cell, oh sorry, we lock the column here, we lock D. However, we want to make it flexible if we drag it down, so we do not lock we do not provide string in front of the numerical here. All right, and C9 here, as we can see, this is C9 is the value of your debt issuance, and we see the C9 here is a 15 million rupiah here. And PV, we do not, sorry, FV or FV, future value, we do not use this one, so we can just type a semicolon or comma according to your your Excel type, and the type is 0 here. And again, we also put if error here in case of error. I'm sorry, there is a thunder here right now, but I hope it doesn't destruct the audio quality. We also use if error in order to return the value to 0 if some error exists. And the double if here, this is actually very similar with what we have learned before in calculating the depreciation expense. It indicates if the period is exceeding the due period, the value will be 0, or if the period here in the specific forecasted year less than the due period, the debt payment schedule is also 0. So very similar with calculating the depreciation expense. We can see in year 2025, for instance, you acquired the debt in 2025. The due period is 5 years. So from year 2021 until year 2024, there are no uh, principal payment here. And since the period is only 5 years, so it stops the principal payment calculation after year 2029. So that's how we calculate the principal payment. The total debt payment, you just simply add the payment in each year, in each specific forecasted period, and you will have the total debt payment. All right. So let's move to another topic, which is interest expense calculation. Basically, the formula here is also similar with the first one with the principal payment. However, we use different argument here. If we use PMT in here for calculating the principal payment, in order to calculating the interest expense using the effective interest method, we use IPMT here. IPMT here, alright? So IPMT indicates the interest payment. We need to find the rate here first. The rate is in cell E16. Don't forget to also put string before E, and the PER indicates in which period the interest payment is made. So for example, if the year is 2021 here, and it is we deduct it with the issuance, with the debt issuance year, which is in column B16 or 2021 plus 1. So year 2021 will be the first period. Meanwhile, if you are in year 2022, the period is year 2022 here, deducted by year 2021 plus 1. So year 2022 is in the second period of interest payment. Alright, so again, this is how to calculate the PER, the G3 cell, G3 here, the current year. You just lock the column here, or in front of, put the string in front of the numerical value here, because we want to we need the period for each forecasted year. So the column here, the alphabet should be made flexible, and do not put string in front of G. Alright, so that's how to calculate the PER, less deducted by the issuance period plus 1. After that, this is the period, the NPER, the due periods here. The due periods is in cell D16, and PV here is the present value of the debt issued, or it could be said as the amount of debt issued, and just leave it blank, or just put a semicolon or comma here for the present value, and the type is 0. again, you need to put if error here. In case there are some error, it will be returned to 0. And this one, these two ifs here also indicates the similar logic with the debt issuance and depreciation expense here, in which if the period is exceeding the due periods, there will be no interest payment again. While if the specific forecasted period is less than the due periods, there will be also no interest payment here. Okay, so that's how to calculate the interest expense. So here we have principal payment and interest expense. And and after that, we could calculate the ending balance of our debt. In order to do so, we need the opening balance here. Of course, in the first period, you do not have any opening balance. So just put 0 here and use a blue font color as an indication that this is a manually input. And the debt issuance here, again, you use sum if here. Sum if formula is similar with what we use in asset calculation here. In here, so it indicates whether in a specific year whether there is any new debt issuance or not. For instance, in here we use some if here. Range is B9 until B11, which is the year in here, while the criteria is the specific forecasted year, and the sum range is the issuance here. So for instance, in year 2021, because you have any debt issuance here, it will be 15 million rupiahs here. However, in year 2022, you do not have any new debt issuance, so there will be 0. So why we use sum if here? This is very useful if you have more than one debt issuance within a year. So for instance, if you have another year 2021 here, let's say we have another debt issuance in this year, amounted, for example, 5 million, 50 million. The due period is, let's say, 6 year, and the interest rate is 6%. And you just can copy this one and copy this one, drag it to the right. Okay, and in the interest expense calculation, we simply add the new debt here. And for the interest expense calculation, we also simply can copy the rest of the formula here. And here it stated in year 2021, your debt issuance is not only 15 million, but 15 million added by 50 million here. So your issuance is $65 million. So this is why we use sum if in order to find the amount of debt issuance in each year. So it makes your formula more flexible. So you do not have to input other formula if, for example, you want to change the number of period, or you want to add another debt in the same year. Alright, so I will just erase this one because I do not want to use this. Okay. Alright, fine. So this is how to calculate the issuance one and the repayment. You can just simply the repayment here, you got this from total debt payment, while the interest expense, you get this from the total interest expense in cells G19. All right, so the ending balance of your debt is opening balance added by issuance less repayment and less by and deducted again by interest expense. So it will be your closing balance of debt. And again, the ending balance of a certain year will be the opening balance in the following year, and so on and so forth. So that's how to calculate the interest expense. Of course, the interest expense here will be the input of interest expense in your operating budget. So just refer this one, the cells in interest expense with to the interest expense in financing schedule to get the number of interest expense. Okay, because we do not use comma here, minus here. I will choose to put the minus sign before here. So because the format is without the minus sign, so I will choose minus here. All right. And after that, we already have the interest expense. We already have the total debt, the debt in the ending of the year, in ending of each year. And the last one is equity financing schedule. This is more simple compared to calculating the interest expense and the debt principal payment. This is very simple. Oh, you just need the opening balance here. This is according to your input assumption again. For instance, in the very first year, you do not have any capital and you issue a capital of 20 million rupiahs. For example, the owner or the shareholders issue inject the capital for 20 million. You choose it here and identify whether in the next following years whether there are any other capital issuance again. And this is the repayment. We do not have any capital repayment. And the ending balance is simply adding the opening balance with issuance and repayment. And dividend, the color is blue. It indicates that the dividend here is added manually from your input assumption. So the color is blue unless you provide one worksheet here for your input assumption, and you can also refer the percentage of input, the input here to your input assumption worksheet. So the dividend payment will be like simply by multiplying the ending balance of your equity with the percentage of dividend. Okay, the final topic for today is to create a landing page for your financial modeling. Basically, even though we create the landing page at the end of the process, the landing page is inserted at the very beginning of your financial model file, because the landing page is like the table of content for your financial model. So once the reader read your financial model, they will know what are the contents of your financial model, and they could simply like clicking the content and go directly to the desired worksheet. So I will teach you how. This is actually very easy. The your business name here, you can replace this with any with your business name. And or if this is an individual assignment, because I also want to give you an individual assignment on operating budget, you could just simply replace this with your name. So this is the content. The first one is operating budget, and I will teach you how to create this. So you have insert tab here. Just click insert and click link in here, and the hyperlink will be linked to place in the document. For instance, I want to make a contents for operating budget. So place in this document is operating budget, and I click OK. And if you wish to change the display name, you can change this operating budget and click OK. Actually, it already appear here, but it is white. So just change the color to blue or to black. Okay, I will change it to blue. And if we click this, it will directly go to the desired worksheet. This is the operating budget, and you could create the description of your contents here. So that's how to create the link. And in each respective worksheet, you can also place a home button here. So when I click home here, it will be back again to the landing page. The step is also similar, just link insert link here, and choose place in this document and click home, and just change the name home. Okay, and change the font color. So that's how to create a landing page and hyperlink. You can also, of course, modify the font size or the font style or the font color here. And please put the hyperlink in the place that is accessible and easy to be found for the reader of your financial model. So I think that's all for today. We already learned about how to create the operating budget, and also creating PPE schedule to calculate the depreciation expense and the ending balance of your fixed and intangible asset, and also financing schedule in order to find the interest expense and also the ending balance of your debt and also your equity. That's all for today. I hope it will be beneficial for you. Thank you very much for watching this video.